Good morning, it's Richard Pearce from FinextraTV, and we're doing our Predictions 2021 series, and joined today by David Harris, who everybody knows is the head of the group head of the sustainable business at London Stock Exchange. David, how are you?
Very well. Hi, Richard. Thanks for having me.
We were just chatting and saying it was 11th of March or something, which was when we last did an interview face to face in London. I mean, what a long time ago that seems.
Yes. Last day in London. Haven't been back since, and what incredible changes we've seen since then.
Absolutely. Well, and we're here just to chat about, predictions for 2021. Looking back as we were, we were talking last time about the EU taxonomy, the Green Finance Institute, COP26. Obviously, that changed in the calendar. Measurements. Where's the industry going? So let's have a look at this for 2021. Where are we and what's happening? And first of all, give us a sense on first of all the big change which happened yesterday in the US.
Yeah, no, absolutely. So, what we've seen, since we last spoke, is just the momentum around sustainable investment, sustainable finance has just accelerated completely. Through COVID, through the pandemic, it's not caused any slowdown; it's accelerated things. And I think and what we're seeing, particularly as you say, just yesterday, with the inauguration of President Biden and Vice President Harris, is we're going to see just even more acceleration of these trends. So. If we look, say, at asset owners, the pension funds have driven so much of the growth in this space, and but in the US, the asset owners, we've seen the drive from the public funds, particularly the East and West Coast, but from a lot of the corporate funds, there hasn't really been action at all. If I think about, we did a survey last year of asset owners, the average globally amongst asset owners who were integrating ESG into their smart beta index funds was over half, 58%. But in Europe, it was 81%. The US was just over 40%.
Wow.
So much lower in the US. What I'd expect to see would be, that's gonna with changes in the mood music from the Department of Labour, we'll see much more adoption and a lot of US asset owners coming to the table. So I think that's going to be a big kind of background driver, but also just the US being engaged on sustainable finance and investment and all of the underlying themes is just going to cause an acceleration across a whole kind of series of areas.
Yeah, absolutely. I think we're all seeing all of that in the appointments that are going into place already. The presidential directives that are actually happening there. A lot of that will lead into, won't it? Things like COP26 now, of course, in the UK, and of course that's part of the mood music coming out of the UK in terms of the let's build the relationship on common themes, climate being a headline topic coming out of Downing Street. How do you see COP26?
When we last spoke, we were expecting obviously COP26, last November. It's been postponed obviously to this November, and I think actually that gives us an opportunity to achieve even more ahead of it. So if we kind of wind back to Paris, that was COP21. Then it was all about, hitting kind of 2 degrees, staying under 2 degrees average warming, ideally under 1.5. This time, the focus is about net zero plans, not just for governments, but for companies, for investors as well. And with the US coming back to the table, as you say, just yesterday, re-signing the Paris Agreement, we're going to see a huge focus here. I think, so over the course of the year, we'll see a lot of announcements about net zero. What does that mean? Practical targets. What does implementation mean? And I think also this kind of interconnection between investors and companies is going to be so important. The big initiative there is Climate Action 100 Plus. Their climate benchmark brings together all of the big investors and aligns their engagement with companies on climate. And so TPI, the Transition Pathway Initiative, forms the core part of that data for CA 100 Plus. We're looking at how we bring TPI into index designs. So we'll be also looking at EU Paris aligned benchmarks, but powering that with TPI data, but also bringing TPI into established indexes like FTSE for Good. So just a couple of days ago, we announced that actually we're going to be ramping up the thresholds on FTSE for Good, but also aligning the climate methodology with TPI. I think the marketplace is frustrated at all the different standards and methodology. and we need to start trying to try and bring those together.
Yeah, I think that's really interesting, isn't it? And using that FTSE for Good, which has been there for some time, is this rising quality benchmark, is just an important lever, isn't it, to operate. And you touched there on sort of regulation and standards, etc. Tell us what you think your predictions are around regulation and standards.
So this has been another area of just incredible development over the last year. So there's been a lot of us which have been calling for IOSCO to start to play a role to try and prevent regional fragmentation, where you get lots of different standards being set across different markets. That's now obviously coming to pass. We've got IFRS just completed their consultation in December and looking to set up their Sustainability Standards Board. We've also got the initiative with all of the different standards bodies, the 5 of them coming together, saying they were going to work together, but then making practical steps along that pathway. So with the coming together of SASB and the Integrated Reporting Council, for example, is one piece of that. Them also coming up with their kind of agreed piece around a climate protocol, which potentially can feed through into the IFRS and IOSCO approach, links in with TCFD. So potentially what we're seeing is these frameworks finally starting to come together, getting some kind of global standardization. There is some risk here though as well, which is that potentially Europe is doing a lot of great work, but there is a risk that there could be Europeans could go off in a different direction here. You've got work going on the NFR, on the Non-Financial Reporting Directive. The EU group EFRAG is feeding into that. Hopefully that will stay quite well aligned with global developments. The things don't need to be exactly the same, but we do need to get them to be kind of interoperable. We need to have a common language. There can be differences, but we need to make sure that these fit together and can kind of work together. So potentially this is a really important year for bringing these standards together. Also interlinks all this is taxonomies too. So it also links to the regulation point. What we're seeing is lots of taxonomies being developed around the world, the EU one being the most developed, but them also developing many other markets, including the UK, announcement about a UK taxonomy. For us, again, it links to the regulation point, is also that this is becoming more regulated. So we have a service, Green Revenues 2.0, covering thousands of companies looking at and breaking down their revenue by different green sectors and subsectors. Investors are going to need to start to report on what proportion of their portfolios are aligned with the EU taxonomy and need to be able to do that. So we're expecting a lot of usage of for this kind of data, not only for kind of direct investment purposes, but also for kind of regulatory reporting too.
Yeah, absolutely. And do you see, the one we always sort of end on, which is in terms of the serving of all of those through data, and obviously you guys are a data engine, absolutely these days. What do you see in terms of the technology and the data providers actually helping serve all of those standards and regulations?
So there's going to be, we're seeing already huge innovation in data. So corporate data is very important, and we've been talking about the standardization of that, but there's also whole varieties of other kinds of big data, AI, satellite data, sentiment data, but it's making sure that we've got robust information from those. Sometimes it cannot be very transparent, and that transparency with the regulation as well is going to be very, very important. But it's how can that corporate data be supplemented by a whole variety of other data types. And that's going to be another area where there's going to be a lot of acceleration, a lot of focus in developments, and also some consolidation as well around that. And then how do you apply all of this across different asset classes? It tends to be a lot of focus on corporate data, but actually how do we apply this in sovereigns? That was I think this last year was our climate WGBI, the World Government Bond Index, but actually it's a very underserved area. Investors need good data on sovereigns, need it on real estate, on infrastructure, private equity. So how do these different pieces start all to come together? So you've got a consistency in thinking, but you've got the right kinds of approach across different asset classes too. So it's going to be, we've seen incredible developments over 2020. 2021 is just going to get even faster.
Yeah, so we're all going to go back to sort of the Rubik's Cube of data, but we've got to pivot it all to green as quickly as we possibly can. Wonderful. David, thanks so much for sharing your thoughts. I know what an incredibly busy guy you are, so it's always appreciated, and look forward to catching up next time.
Thank you very much for inviting me, Richard.